All right, hello everyone, and welcome back to Module 7. This is a really exciting module for me because this is my favorite way to structure fix and flip funding using other people's money. This is where we're going to talk about the debt equity blend. And I like using this structure because I consider it the optimum structure for fix and flip funding. Now, before we dive too far into the strategy, I got to share with you the disclosure. I am not a licensed attorney, accountant, financial advisor, broker, or agent of any kind. I am not a licensed individual. I'm just a student like you. I've been very successful with these strategies that I've used, and now I'm going to share them with you. So hopefully that's okay for everybody. Let's talk about the debt equity blend. I'm excited because this strategy is the one that I recommend. This is my favorite strategy for funding fix and flip properties because it keeps us safe and it allows us to maximize the profit and maximize the funds that we have available to us to be able to scale our real estate business. So let's go back to the calculating your costs. You've seen this, a similar slide to this in the other strategies that we've talked about. So let's go ahead and calculate the costs on how a debt equity blend would work. So identify the loan amount. Now here's the thing about the debt equity blend. There's a secret formula to how we structure the debt versus the equity. And I want you to write this down. That whenever you're using the debt equity blend, you want to structure 2/3 of your total raise. So that's the amount to purchase the property and to fix it up and have enough to cover utilities and taxes and insurance and those things. So for the example we've been using of 123 Main Street, we've used our total raise at $300,000. So that means 2/3 of $300,000 is going to be a $200,000 loan. Now, whether that comes from private money or from a hard money lender, it's going to be a debt relationship because debt is cheaper than equity. So we're going to leverage that and use it in the formula to be able to lower our costs overall. So a $200,000 loan, points, if we're using the example of 2 points, which is pretty common in the hard money industry, then our total cost of points on a $200,000 loan will be $4,000. Then we calculate the interest. $200,000 loan at 12%, which again is a pretty standard number in hard money, is going to be $24,000 annual interest. Now that only applies if we're going to hold the property for a year. But I always like to run my numbers at 6 months. That kind of gives me a good range to be able to get the project done. So we got to calculate the per diem. We're going to take that $24,000 annual interest and we're going to divide it by 360. Remember that a financial year is 360 days. So we divide that by 360. That's $66.67 per diem. That's just a fancy Latin way of saying per day, but that's what the loan industry uses. So you got to know that term per diem. That's $66.67 per day in interest charges. So at $66.66 per day times by 180 days, which is roughly 6 months, that gives us a total interest cost of $12,000.60. Now let's take those two things and let's combine them together. $4,000 worth of points plus $12,000.60 in interest plus $500 in other fees. Remember those hidden fees from hard money lenders. $16,500.60 is our total cost of funds. So if we have a $60,000 margin, and again, our margin is calculated based on all of our costs, not including money. So all of our costs, not including money. So take your after repair value and minus all of your costs, the cost of purchasing the property, fixing it up, your utilities, your closing costs, all of those things, agents if applicable. If we're left with a $60,000 margin, we subtract our $16,500.60, which is our cost of funds. That equals a $43,499.40 projected partnership net profit. So that is the profit that you and your equity partner are going to split based on whatever percentage. And if you go back to the previous module, you'll see how we structured that based on whatever percentage you've agreed on with your equity partner. Now your equity partner then only has to bring the other $100,000 to the table. Because remember, we needed $300,000 to make this deal work. We raised $200,000 of it, the 2/3 in debt. That means that we raise the other $100,000 in equity. So they bring that to the table. So you need a little bit less from your equity partner to make it work. And if you're gonna let's just use the example and say that you're gonna split that 50-50. So that $43,499.40 divided in two is $21,749.70 per individual. So obviously a safer way, a more scalable way. There's definitely ways you can make more money in a single deal, but they're a little more risky. I would rather personally make slightly less in a single deal, but free up my time and free up my capital to be able to go out and do multiple deals and do them safely so that I can make more money overall, right? So let's take a look at how that looks. So in our example with the debt equity blend, here's our 1, 2, 3 Main Street numbers. We need $300,000 up front. We're going to raise 2/3 of that in debt. That's $200,000 at a 12% annual interest rate. Our other $100,000 comes in from our equity partner. And the way that we structure that is we're going to go out and we're going to talk to the equity partner about bringing in their funds. And we're going to structure that in an LLC in a lot of cases, or in some cases, a joint venture agreement. But in this case, we've talked about doing a 50-50 split. So the way that I approach that with equity partners is I go to my equity partners and I say, hey, look, whatever your current rate of return that you're getting is, let's take a look at what it's going to take to get you a better return and to maybe put that into a more secure place. How about you partner up with me on a fix and flip transaction? We're going to start an LLC and I'm going to be half partner in it. You're going to be half partner in it. Here are the numbers over on the left-hand side. Here are the numbers, the projected numbers on this deal. All in all, we're going to make about $43,000 in profit. That means when it's all said and done, I'm going to get $21,500 and you're going to get $21,500. Now, here's where doing the math is a great way to pitch money to an equity partner, because if you do the quick math on this, they put $100,000 in. It takes about 6 months to complete the project. Usually, I like to hit 4 months, and I think I ran the numbers at 4 months on this particular slide. You can adjust those numbers based on where you feel comfortable. Never overpromise, always underpromise and overdeliver, right? So if you run the calculation, their actual rate of return on that is 21.5%. That's hard to beat. So if they've got their money tied up in a CD at their bank or in a money market somewhere, they're not getting 21.5%. I can promise you that. They're getting like 3 or 4 or 5%, right? Mutual funds yield, a lot of people say 12%. I think that's a little generous, more like 7 to 8%, So the fact that they can get a 21% actual rate of return by putting their money into a deal like this is pretty awesome. And it gets better than that, because notice that's an actual return. When we're talking about mutual funds or returns on CDs or money market accounts, they're talking annualized returns. So it usually takes less than a year. In a lot of cases, in successful cases, it takes less than a year to do a fix and flip. So if they're doing this in 4 months, well, their annualized rate of return is 3 times that, because there's 3 4-month periods in a year. So their annualized return is going to be more like 64.5%, right? Which is awesome. Now, obviously, this isn't an investment for them. You have to be very careful on the vernacular when you're referring to an equity partner. They are not an investor. You're not asking them to invest, because in most cases, a lot of you aren't going to have securities licenses, so you can't sell investments. What you're asking them to do is partner up with you. So make sure you use that vernacular. They are partnering with you, right? And your debt relationship, that is not an investor either. That is a lender. So debt is lender, equity is partner. You're the investor, okay? So don't ask people to invest with you. You're going to find yourself wearing an orange jumpsuit if you do that too much and something goes wrong. So make sure you use the vernacular that's going to keep you safe, that's going to keep you compliant with the law. Your equity relationship is a partnership, and your debt relationship is a lender. So partner and lender, right? So You can show them these numbers and people get really excited. I mean, this exact slide, a lot of times will write this on a napkin, or, I'll print out something that looks really pretty, and I'll take it over to their house and sit down with them and show them exactly, what that looks like. So my projected profit, my projected net partnership profit on the deal, split into two, or whatever percentage that you want to negotiate with that person, showing them that they're going to get a much higher return than whatever it is that they're currently doing is very attractive to them, and in a lot of cases turns out to be a successful pitch, and get it, and I often get equity partners into deals just simply by showing them what that looks like to their pocketbook, right? So another important thing to talk about is what happens if the deal goes bad, right? We talked about the debt guy back a couple of modules ago, and how I always go back historically and I look at what the property value has done over the last 10 to 15 years, and I take the lowest number and I set that as my low watermark. What happens if if 2008 happens again and the property drops to $280,000 while we own it? Well, if you're the debt, if you've only structured debt, then you're pretty much sunk. And if you remember, I talked about like that. That's why a lot of people lost money in 2008, because they didn't prepare themselves for exit strategies. I love the debt equity blend strategy because it opens up a ton of exit strategies for us. If you're the debt guy and your value drops to $280,000, you can't sell it because you're upside down. You can't refinance it because you're upside down. You can't rent it out because a lot of times hard money and private money have a term attached to them. In fact, in every case, hard money and private money have a term attached to them where they get the property if you don't perform within that term. So none of those exit strategies will work, and you're just sunk. But with the debt equity blend, if our value drops to $280,000, then we've got a lot of options opened up to us, because look at how much debt we have. In this case, we only have $200,000 worth of debt. Our equity partner's in with us along for the ride. So we could potentially take this $280,000 property down to the bank, refinance out our hard money guy, our debt guy, into a long-term mortgage. And maybe you can do that on your credit. Maybe it's the equity partner's credit. Maybe you bring in a third partner as a credit partner in the eventuality that you have to do that. But you've now replaced the short-term money with long-term money, and you can just make a simple monthly payment towards that mortgage. And think about it for a second. If you've got a 30-year mortgage based with an origination of $200,000, and you've got a property with a value of $280,000, your mortgage payment is going to be much less than what you can rent it out for, because your mortgage payment's based on $200,000, and your rents are going to be based on the value of $280,000. So there's going to be cash flow. So if you have to use an exit strategy and turn it into a rental, you and your partner are going to share 50-50, or whatever ratio you guys end up working out. You're going to share that cash flow every single month until the market turns back around and you can sell it for what you originally intended on, your $380,000 in this example. And he makes $21,500 and you make $21,500. Worst case scenario, he makes more money. So this is safe. You don't get that kind of safety in the stock market or mutual funds, right? If the economy tanks and you got your money in mutual funds, well, your retirement tanks with it, or your money tanks with it, right? But if in the case of something like this happening, you can rent it out and you get all of that cash flow every single month for as long as it takes to turn that property value back around, for the economy to bounce back, which historically it always has, right? So and then you sell it and you make the original profit you planned on. He makes more money, you make more money. The only downside is you're in it for a little longer than you thought. So for those of you who thought real estate investing was risky, a simple strategy like this turns that around, right? It just takes knowledge. Now, you'll notice something. In this example, I put me, but this would be you in that case, right? You put $0 into this property. You put $0 into this deal, and yet you got a $21,500 return as well. So let's calculate your rate of return. What is it? You put $0 in, you get $21,500 out. What do you make? What's your rate of return? The answer is I feel like a third grader when I say this. I made infinity percent on this deal, right? And I love making infinity percent on every deal. That's the best possible rate of return that you can make on any investment. So obviously this puts everybody in a really strong position. That's why I really love this strategy. And now a lot of people have asked me, well, why is it that the guy that put the least amount of money in makes the highest rate of return? And the answer is because I put a different currency in. And that's the same answer that will be applicable to you in this scenario. And that is the currency that we put in is knowledge. If your equity partner knew how to do this, he wouldn't be putting his money into mutual funds. He wouldn't be or her money. They wouldn't be putting their money into CDs or money market accounts. They would be out doing this, right? So the knowledge that we're bringing to the table is the currency that we're investing, so that we can go out and do it safely and provide a nice cushy profit for everybody involved. And obviously there are always risks, but this has proven over the course of my real estate investing career to lower the amount of risk that we take on in each and every property. Now, let's talk about some other things, pros versus cons. A few pros to the debt equity blend. So we can optimize scalability. When you use only an equity partner to structure a deal, in the case of our example deal, you're going to need $300,000 to go do that deal. Now, granted, you each make 30 grand, right? And you don't have to worry and fuss with a debt partner. So you're going to make a little bit more money, about $8,000 maybe more on this individual property. But think about if that equity partner has 300 grand, you could go out and do 3 properties just like this all at once using the debt equity blend rather than solely an equity partner relationship to fund the deal. You could go do 3 properties just like this, and you're lowering their risk because you're diversifying their portfolio, right? All of their money's not tied up in one property. It's tied up in 3 properties. So if one goes bad, you got 2 others that could go good and still make money. You're also making your capital go further. If you could hypothetically make 21.5 on 3 deals, that's better than making 30 on 1. And that's why I really love this strategy. It optimizes the scalability, it optimizes the risk, it diversifies funds, and it gives you more exit strategies. The cons, however, it's a little less profit per deal, but if your strategy should be to build a scalable real estate investment business. This isn't about doing onesie twosies. Nobody's going to get rich off of doing onesie twosie fix and flips, right? We want to build something that's scalable where we can have control over the risk as much as possible, and that's what the debt equity blend does for us. So go out and use that debt equity blend strategy. Now make sure that, like we said before when we were talking about any equity partnerships, make sure that you're using an attorney to draft all of your joint venture or LLC agreements, and your attorney may have maybe other types of entities that he wants you to use. It's all going to be based on the property, based on your relationship with the equity partner, and several other things that I can't specifically speak to in this forum. But your attorney will be able to help you navigate in each individual scenario. So make sure you do that. That brings us to the end of the debt equity blend module. We're going to move on next to module number 8, where we talk about how to use other people's retirement funds to go out and do real estate investments. So we're going to talk a little bit about other people's retirement funds. We're going to talk a little bit about how to use your retirement funds. That's all coming up in module 8. So stay tuned. We'll see you over there.